Okay, let's start. I'm Sunghwan Shin from the Bank of Korea. This session, edging towards a fiscal cliff, is basically on how far fiscal debt can go and at what cost. I mean, the cost in broad sense. The time plan of the session is like other paper session, 20 minutes to each speaker, 14 minutes to each discussant. Because two papers are closely related, two papers will be presented first, then discussed. Then I'll open the floor for audience questions and comments. So let's start.
All right, yeah, thank you, Sunghwan. Perfect. So let me start by saying that this is very preliminary research with two co-authors. The first one's Matyas Farkas, he's at the IMF. And the second is John Hartley, he's at Stanford. So Matyas is at the IMF, so I'll include the usual proviso that the paper doesn't express the views of the IMF or its management. Same for me with terms of PIMCO. If you want the PIMCO view, just wait until lunch and you'll hear it from Rich Clarida. And then John Hartley, one thing I'll mention here, he's going on the academic job market this year, so do watch out for him. Okay, so as a way of introduction, I'm going to contrast two different views of a very famous equation that we've been talking about a lot over the last day. That's the government's intertemporal budget constraint. So the first quotation here, that comes from a paper by George Hall and Tom Sargent in the AER in 2011. They cheekily referred to the government's intertemporal budget constraint as, quote, the least controversial equation of macroeconomics. And if you know Tom Sargent a little bit, you know that this is something that he likes to say. I'm going to contrast that. So about 10 years or so later, a set of co-authors, including Zhengyang, wrote this paper, brilliant paper in Econometrica, and this is a statement that comes directly from their abstract. They say that the risk in surpluses creates a large gap between the market value of debt and its fundamental value, suggesting that US Treasuries may be overpriced. So to me, that doesn't sound very uncontroversial. And also, if you look at their Econometrica paper, it's interesting, in the footnotes at the first part of the page, they mention all the people who provide comments. It's like a laundry list of almost every single person in the economics profession who at one point discussed or commented on their paper. So that's the puzzle that Zhengyang and his co-authors really presented a few years ago. And in their paper, they really go over a few different explanations for why the market value of debt, at least in the United States, seems to exceed the fundamental value by so much. They include explanations like a rational bubble. You might think this is crazy, but actually Marcus Brunermeier has a series of recent papers that takes this idea very seriously. Convenience yields, we heard from Mindy yesterday. They actually have a follow-up paper where they try to calculate convenience yields using very long-run data and show that maybe it can resolve the puzzle, but the convenience yields seem a little bit small empirically to do so. Peso events, maybe surplus. Bond investors are anticipating some sort of very large fiscal correction in the future that hasn't happened yet. It seems like that'd be very unlikely relative to the large gap that they find. And then lastly, unmeasured government assets. I'm only going to mention this because I was a Sloan Finance PhD student a couple years ago. Actually worked for Debbie as a teaching assistant for a PhD class. I remember we actually had a whole discussion during one of the classes about Zhengyang's paper mentioning the unmeasured government assets. Debbie made a whole bunch of very brilliant points about it's not just like the land of the government, it's the fact that the government could conscript a large percentage of the population to serve in the military. The government could take over other countries and expropriate wealth. These are very, very hard things to model, but ultimately this is kind of the black magic or dark matter that could resolve the puzzle. So we're not going to be that ambitious in this paper. What we're going to do is really two very simple elaborations of the original Jiang et al. Approach. The first thing is, so the original paper applied to the United States. They've since looked at the Netherlands and the United Kingdom. We're actually going to extend their approach to a panel of 14 advanced economies since 1950 to see if we get very similar or similar at all valuation gaps for other countries. And we'll actually go through the evidence and we'll see that the valuation gaps roughly coincide with, I think, reasonable priors and or stereotypes about different countries. The Germans don't have a valuation gap, but the French do. The second thing is we have a tension here between the valuation approach that Zhengyang and his co-authors take and something called the fiscal theory of the price level that I think has been most recently advanced by John Cochrane and Chris Sims and co-authors. What does the fiscal theory of the price level predict in this context? Well, it basically says that when you have a positive valuation gap, like we see for the United States, and where debt is worth more than its fundamental value, that tends to be associated with a positive inflation surprise. Debt is overvalued relative to its future surpluses, so the price level has to increase in equilibrium in order to justify the low expected surpluses. That's a very strong prediction of the fiscal theory of the price level that, to our knowledge, no one's actually tested yet. So we do that. We run that test. We develop a model for inflation expectations across different countries historically, and we actually find that, well, it's qualitatively consistent with the fiscal theory of the price level. In instances in which you have a large positive valuation gap, you do indeed find that unexpected inflation is higher. So there's a positive inflation surprise. The only problem is we don't think that that's a resolution of the debt valuation puzzle, because if you take the estimates from our panel regression at least and try to infer what the unexpected inflation would have to be to close the gap, they're orders of magnitude off. So it really isn't an empirical rationalization of their puzzle. So just to motivate the paper initially, so this first equation, this is the government debt valuation equation. This is directly from John Cochrane's recent book. What does it say? Well, it says that the price level, that's going to be PT in the denominator on the left-hand side, that's going to adjust so that the real market value of government debt, so BT minus 1, that's the nominal amount of debt that's pre-existing going into the period, that's equal to the present discounted value of future surpluses on the right-hand side. And we're going to be discounting using the stochastic discount factor M, although in the paper we're not going to take a stance on the exact model of the SDF. What we're going to do here is actually consider a very reduced form generalization of this equation. So what we're going to do is try to kind of capture this notion that the government could have different degrees of fiscal backing. So the government could have a different amount of commitment to run surpluses in the future to pay off debt. And the very simple way that we came up with, and there are, of course, many different ways of actually modeling this, is just to assume that there's some sort of fraction, we call it lambda, of surpluses that's credibly committed to debt repayment. So equation 2 on the slide is just a generalization of equation 1. You can think of equation 1 as the case in which the government actually exhibits full fiscal commitment. And what's the idea here for the intuition from the fiscal theory of the price level? Well, an increase in the price level on the left-hand side is going to arise from a lower degree of fiscal backing. So if investors believe that the fiscal backing is lower on the right-hand side, in order for the left-hand side to fall, given that nominal debt is predetermined, the price level has to go up. You can even think of that as a form of default via inflation or an inflation tax. Okay, so that's the FTPL logic. How do we tie that back into the Jiang et al. Debt valuation puzzle? Well, we're going to assume here that bond investors, those are the ones who actually price government debt, they don't know the true degree of fiscal backing. They have some sort of belief about it. We're going to call that theta hat, and that's what they use to price government debt. They don't know the truth. There are different ways of microfounding this. You could think about it like slow learning, some sort of Marson and Sargent explanation. We're going to be agnostic here and just say that investors, they have their own belief about fiscal backing. It's not necessarily the true amount of fiscal backing that you'd estimate in a VAR over the full sample. And what does that imply? Well, assume that investors believe that fiscal backing is higher than the true amount. So theta hat is going to be higher than just theta. Well, what that implies from some algebra is equivalently that the actual price level, PT, will have to be greater than the price level that's expected by bond investors. Equivalently, that there has to be a positive inflation surprise in order to equilibrate that equation. So what's the basic intuition here? Well, the valuation gap that you calculate in Zhengyang's paper is really a signal of over-optimistic fiscal backing by bond investors that's going to be subsequently corrected by surprise inflation. And actually, Zhengyang and co-authors, they have a paper where they make this argument. A large positive valuation gap is consistent with Treasury investors being over-optimistic about future surpluses. What we do here is just take that logic one step further, is that if you believe in the fiscal theory of the price level, that over-optimism about future surpluses could be and should be equilibrated by surprise inflation. Okay, last thing here, just about their method, and Mindy went over this yesterday, so I won't belabor the point. How do we calculate the present discounted value of future surpluses in their framework? Well, we're going to follow their method where they derive an upper bound to try to be as conservative as possible on the present value of future surpluses. So the authors have this equation on the slide where basically the present value of future surpluses scaled by GDP, that's Y, is equal to tau, that's the tax revenue to GDP ratio, times the price dividend ratio on a claim to all future tax revenues, minus the government spending to GDP ratio, times the price dividend ratio on that government spending claim. The log price dividend ratios, those just come from a standard Campbell-Schiller log linearization, but how do you get the upper bound in their framework? Well, okay, I want the left-hand side to be as large as possible. That just basically means I want the first term on the right-hand side to be as large as possible, the second term on the right-hand side to be as small as possible. What does that actually mean economically? Well, they first note that because both tax and spending claims are exposed to the same long-run risk as GDP due to this co-integration with between taxes and spending and GDP, they're going to share, a GDP risk premium, and that's in the long run. In the short run, because tax revenue tends to be pro-cyclical, government spending tends to be counter-cyclical, the risk premium on the tax claim is actually bounded below by this GDP risk premium, while the risk premium on the spending claim is bounded above. So the upper bound is really going to equate the risk premia on those two claims, the claim to all future taxes, the claim to all future spending, to the GDP risk premium. That's how they get the upper bound. Again, we just do this to be as conservative as possible with our empirical results and to be consistent with their paper. Okay, so what's the empirical framework that we do? All right, so Jiang et al., they have this method they develop in order to estimate the present discounted value of future surpluses. The one thing is you actually need to model the process of future surpluses. So the way that they do that is they assume that there's this large vector of state variables, 11 of them in our framework, and it follows a constant coefficient VAR with one lag, and that's the first equation on the slide. The first thing that we actually thought of here is that, and this is related to Adrian's discussion of Mindy's paper yesterday, is, there's really nothing that says that the constant coefficient VAR is the true model. Adrian pointed out that there could be some look-ahead bias with estimating this over the full sample. So we tried to do the most complicated thing possible, which is estimate a time-varying parameter VAR with stochastic volatility, which if you know this literature, the two classic references are Cogley-Sargent and Primacheri. I included only one bullet point on this. It's actually computationally quite demanding to do this in a Bayesian way, but we eventually figured it out. So in our analysis, we're going to estimate both this constant coefficient VAR, just like Jiang et al., and also a time-varying parameter VAR, which could encapsulate regime shifts in the dynamics of surpluses over time. And then here's the collection of state variables. Most of the macro variables come from the Jorda-Schuler-Taylor database. We use the post-World War II data in order to be consistent with their paper. And then the spending variables for many countries, that comes from the IMF's Public Finances and Modern History database. Okay, so what's the empirical result of this procedure? Well, I'm going to show you two sets of graphs. So the first set of graphs here, these are the valuation gaps for what we call the prudent countries. And the prudent countries, again, are maybe consistent with some of your stereotypes about these austere Anglo-Saxon countries like the United Kingdom and Denmark, Germany, Switzerland, Australia, the Netherlands. On average, they tend to have a debt-to-GDP ratio, that's the blue line, that's at least kind of close, and if you include the confidence intervals here, certainly within the 95% confidence intervals of the upper bounds on fiscal backing. There are a few kind of exceptions, especially if you use the time-varying parameter VAR early in the sample for like Germany and Australia. But in general, these are the countries that tend to have a debt-to-GDP ratio that's consistent. There's no valuation puzzle for these countries, at least according to the framework and data that we use. We haven't gone through and tried to map these different valuation gaps into the different fiscal policies. I know Jason Harris at the IMF mentioned earlier that there's some research doing this. But we haven't done that so far. We just kind of, tried to summarize the two groups of countries here. What's the second group of countries? Well, we call these the profligate countries. So these are 8 of the 14. These are, again, the usual suspects. United States, this is exactly matching the empirical results that Zhengyang found, where for the vast majority of the time series since World War II, the debt to GDP ratio for the United States has been above the present discounted value of the future surpluses, maybe with the exception of a brief period in the late 1990s. You also have Italy, France, Japan. Japan, of course, at the end of the sample, there's a very large gap between those two numbers. So again, we tend to think that these countries are the profligate ones, maybe with the exception of Sweden here. We're actually unclear about Sweden. The algorithm identified it as a profligate country, but there are instances in which its debt to GDP ratio is actually pretty close to the upper bound. Okay, so again, the whole idea is that we extend the Jiang et al. Approach to a whole 14 different countries since World War II. We estimate these valuation gaps, and then we have this prediction that the positive valuation gap through the fiscal theory of the price level should be associated with a positive inflation surprise. What's the problem with that, first of all? Well, if you've worked with macro data and financial data, you kind of know that we don't really have survey forecasts of inflation for, say, Finland in the 1970s. So we had to come up with a way of actually developing inflation forecasts. In the United States, we have the Survey of Professional Forecasters. We have inflation index bonds that go back at least to the late 1990s. But again, we have a sample that goes back to 1950. So what do? Well, we actually extend this approach by a recent RFS paper by Hello et al. To forecast inflation using just government bond yields in the time series of inflation. So what's the basic approach? We have a time series of par yields of treasury securities for different countries at different maturities that go back in time. We can fit a Nelson-Siegel model to estimate the zero coupon yields, and then do the standard thing where we summarize the yield curve using the first 3 principal components, the level slope and the curvature. So once we have those 3 principal components for all these different countries, we can model the joint dynamics of these yield curve factors and inflation using a VAR. And because we're looking at expectations of future inflation, we want to make it sure it's like a pseudo real-time measure. So we're going to estimate the VAR over an expanding window and then just forecast future inflation. As a benchmark, we're going to use inflation expectations over the next year. So unexpected inflation here, that's pi tilde. That's just the difference between actual inflation over the next year and the bond market's forecast. We also did 5-year inflation expectations, and even longer run, you just iterate on the VAR in order to do that. So what's the result? Again, we have this intuition, the valuation gap should be positively associated with inflation surprises. Does it actually hold in the data? So to calculate the valuation gap, we take the debt to GDP ratios, subtract the upper bound, the present value of future surpluses, and then we take the unexpected inflation, regress it on these gaps in a panel regression, so we can include country fixed effects. We also include year fixed effects. And what do we find? Well, we find that a 10 percentage point increase in the valuation gap is associated with a positive inflation surprise of about 3 basis points. So yay for the fiscal theory, the price level. It's actually qualitatively consistent there. We included both the constant coefficient gap here in the regression table, that's the first row, and the time varying parameter gap. Again, we used fixed effects, Driscoll-Cray standard errors, tried to cover all of our bases. But the question you might ask here is, okay, 10 percentage point increase in the valuation gap, positive inflation surprise of 3 basis points, that seems really small, right? That seems quantitatively a little bit too small to explain the amount of expected or the amount of unexpected inflation that's predicted by the fiscal theory of the price level. So to kind of, and these are just the bin scatters for the previous regression results. It looks really nice on the left-hand side when you look at the constant coefficient one, the time varying parameter one. I mean, I give it a C. I mean, it looks like a cloud of points. It is generally upward sloping, but it's not quite as significant. They cut off. Ah, here he is. Okay, final slide. And this is what I was setting up. We got those estimates, 3 basis points of unexpected inflation for a 10 percentage point increase in the valuation gap. The question is that large enough to close the valuation puzzle? Is the fiscal theory, the fiscal theory would imply a very large amount of unexpected inflation. Is that what we get from just our fitted regression estimates? So first thing, you could do a little bit of algebra. And you could show that the unexpected inflation necessary to close the full valuation gap in our framework is equal to the negative log of 1 minus the gap divided by the debt to GDP ratio. Okay, so what we do here is just a very simple back-of-the-envelope calculations. We assume a debt to GDP ratio of 50%. That's going to be like most of your European countries. 100%, that's like the US, and then 200%, that might even be low for Japan. And then assume different estimates of the different amounts of the valuation gap. And then the first row in each of these three panels, that's the implied amount of surprise inflation that would be necessary to fully close the valuation gap. And then the second row, that's just taking our fitted value from our panel regression of the same amount of surprise inflation. And what do you see? Well, just look at the debt to GDP ratio of 100% case. It's like the United States. If there's a valuation gap of 50% in the third column, that implies that unexpected inflation, according to the FTPL, should be 69%. 69% in order to fully close the valuation gap. So if you were to use our estimates from the panel regression and actually plug in those same parameters, you would get a fitted value of unexpected inflation of 0.15%. So orders of magnitude smaller than the actual amount. Now, this is all kind of under the assumption of one period debt. The actual duration of aggregate treasury debt, something close to 7 years. So you should really be smoothing these implied inflation amounts over 7 years. That doesn't really matter, though, quantitatively. Even if you're smoothing over 7 years with long-term debt and the fiscal theory of the price level, you're still an order of magnitude off. So this is where I'm going to stop because I'm short on time. The conclusion here is that Zhengyang wrote an amazing paper. This is a great framework for analyzing the sustainability of government debt. But if you were to try to merge this framework, the fiscal theory, the price level, look across different countries, you see evidence that's qualitatively consistent. These positive valuation gaps are consistent with surprise inflation, but it's quantitatively far too small to be a full rationalization of the debt valuation puzzle. So thank you very much.
While we're waiting, I just want to say thanks a lot for inviting me to discuss this paper. I really enjoy reading it. Very happy to kind of share some of my thoughts. And my discussion, I think part of it is going to be about the exercise to extract the valuation, and part of it is going to be about this critique about fiscal theory. So let's get started. So while I was on my way here, I was reading this macro roundup by Ed Conrad this week. And there were 3 top headlines in this report. So look at what's going on in Europe. French 10-year bonds now trade at a higher spread than Italian. For the first time since 1999, the market seems to think that French debt is riskier. In Japan, long Japanese yields spiked and yen fell in response to the likely new prime minister's reputation as a fiscal dove. And then in the US, as we noticed, the gold spot price has risen 50% since the start of the year and 18% since the Jackson Hole speech. So all of those headlines seem to suggest that fiscal issues are really front and center in today's market. And if we go back to the textbook, what we would start with is this framework with discounted future fiscal cash flows as the fundamental anchor for the valuation of government debt. So in this equation, the left is the observed market value of government debt. Usually we use the real value. And on the right, we have the present discounted value of future primary surpluses. So according to standard asset pricing logic, the value of currency and debt issued by a government should ultimately rest on the right-hand side on the fiscal cash flows. But the relevant question we want to ask is whether this is true in practice. So in the paper that JR referenced, we have done a serious work to estimate the valuation of surplus and compare to the market value of government debt. So these are the results that we have just seen. On the left, these are 1817 to 1950, so before the Second World War, and on the right, we have after the Second World War, so the modern period. What we find is that for the US, the debt was below this upper bound based on fiscal fundamentals before the First World War, but not since the Second World War. And for the UK, it was the other way around. We also went back in history and looked at the Dutch Golden Age. We also found that the debt was above the fiscal fundamentals. So what we learned from these exercises, which was also replicated by the authors, is that there seemed to be a notion of exorbitant privilege. In international finance, when we think about exorbitant privilege, it's usually about the price dimension. US bonds are more expensive, the yields are lower, but there seems to be also a quantity dimension. Even ignoring the small basis points differences in the prices, the US seems to be able to issue a lot more bonds than the fiscal fundamentals would justify. And then the natural question, as was asked in this paper by JR and co-author, is if this is a feature of exorbitant privilege, would we expect to see this from other countries? If we do the same exercise, do we expect to see from Germany, from Italy, from Japan, all these other countries with varying degrees of the so-called privilege? So in this paper, the JR and co-authors found, well, there are two groups of countries. There are the so-called the careful, austere countries, Belgium, Finland, Italy, Japan, Sweden. Oh, I should say the other way. For those countries, they are like the US in the sense that their level of government debt is way above their fiscal fundamentals. Whereas for the other countries, Australia, Denmark, Germany, Netherlands, Norway, Spain, Switzerland, and the UK, it's the other way around. They do not seem to have issued more debt than what their fiscal fundamentals would suggest. So I think the key question is to understand why. This is a really important and really interesting finding. I think the authors are bringing a lot more value from the cross-country perspective. But what I cannot stop thinking after seeing this result is whether there's a common reason, a common explanation for all these countries in the cross-section, or whether it's like really one reason, one story for one country. So what I want to do in this discussion is to share what my prior would be, having thought about this and read about this in the literature. I'm leaning towards more of a one country, one story type of world. So I would like to share my perspective and hopefully think about where we are in this fiscal conditions across countries. So the first point I want to make is, in the case of Japan, one salient or very different, distinct feature is that the Bank of Japan has been buying a large share of Japanese government bonds. So if we look at the first picture over there, this is how much Japanese bonds were purchased by Bank of Japan, which is red. Compare that with the black line, that is the total issuance. We can see that the Bank of Japan is actually buying more than the total issuance by the Japanese government, especially during the pandemic period. And if we look at the second picture in the bottom, this is a share of long-term Japanese bonds, government bonds held by the Bank of Japan. And if you can look at the red bars versus the rest towards the end of the sample, that's pretty much over half of the aggregate quantity. So that strikes me as something very special, something that is unique to the situation of Japan. And this is also related to the idea of financial repression, which we will see momentarily. So I think the economics and asset pricing mechanics for this situation might be quite different from the case of US, UK, because for those cases, instead of the central banks, at least historically, the foreigners play a big role. And perhaps the market discipline imposed by the foreigners would be quite different than the central bank's role in this market. Another thing worth thinking about is the fact that Japan is a net investor, so they hold a large amount of foreign assets, and that also includes Japanese government and Bank of Japan. So this could be thought of as a negative debt in the form of saving, and that could also be part of the picture, why Japan has this puzzle. My second point is, what about Europe? I have to say I was initially quite surprised about the fact Germany doesn't have issued more debt than the fiscal fundamentals, but the opposite was true for Italy, because if we think about the exorbitant privilege, the role of reserve asset, we usually assign that to Germany, not to Italy. So if we take the US, UK as the dominant safe asset issuer story, we should apply that to Germany instead of Italy. But then I would want to note that there's something quite special about the Eurozone, which could be part of the picture. And what I want to argue in this other paper with Chen, Limbroni, and Lustig is that there is a large-scale implicit cross-country transfer from the core, like Germany, towards the periphery, like Italy, through this target 2 system. So if we think about how QE works, the way it works, for example, in the case of a net purchase of Italian government debt is that first, that was done by the Italian central bank, purchasing the Italian government debt, but immediately that was converted into a target 2 liability. Italian central bank borrows from the German central bank, who issues bank reserve to back up this holding. So eventually, this is Germany putting funds into Italian government debt market. But the interesting thing is that there's income pooling and there's remuneration rate not necessarily reflecting the market interest rate. So the combination of these features would suggest there's implicit transfer, could be another source of the fiscal resource that Italian government has at its hand. So that could potentially resolve this gap between the market debt level in Italy versus the proper fiscal fundamentals. There seems to be another source of income. A third point is when we think about this cross-country exercise, which I think is very refreshing, we also want to think about one model assumption carefully, which is the dimension of risk. This is a picture borrowed from Carlos Weg and his co-authors. He has made this point across multiple papers. That's right? Hi. Yes, of course. Yes. So the interesting finding is that the cyclicality of the fiscal cash flows depends on the level of economic and financial developments. And this cyclicality, from an asset pricing point of view, should be very important for determining the right discount rate to use. So potentially, we should be using very different levels of discount rates for these cross-country exercises. So that's another food for thought. The last point is about this final result. This is the same table that JR has shown. And the key finding is that inflation seems to be at work, but not quantitatively enough to account for these variations in the gap, in the fundamental versus market value split. So I was trying to suggest a kind of alternative story. So also want to mention the name John Cochrane. John Cochrane, over 10 years ago, moved to Stanford. I was sitting in his lecture about fiscal theory. And I was thinking, because trained in the more kind of standard macro tradition, I know that inflation is sticky, right? If we treat that as an asset price, which responds to this government surplus, the cash flow shocks, there's an issue of how stickiness comes into the picture. So this eventually actually became my PhD thesis, which is to think about this as an international version of fiscal theory. Inflation is sticky. It cannot adjust fully to variations in the fundamentals, in the cash flows. But what about exchange rates? Exchange rates are external prices of the government liability, and exchange rates are flexible, at least for these cases that I study. So what I find instead is that the exchange rates are much more volatile, and they strongly respond to the fiscal shocks, whereas inflation is more kind of playing a secondary role. So one thing very much exploring is to evaluate to what extent exchange rate also responds and quantitatively provide another bridge to cover this gap. So that, well, if we can establish that result in this paper, I think that is a lot of evidence for market imposing discipline for this relationship. So I think I'm running out of my time, so let me conclude. I think this is really exciting work. The cross-country perspective to a lot of the things that we discussed in this conference is very important. And I would even go so far as to claim, based on the case of Japan, the case of Europe, like we just discussed, that seemingly domestic fiscal issues probably have to be understood from the broader international perspective. So we want to think about the role of reserve assets, the role of currency union, the role of central bank versus foreign investors in this debate. I think that is a very productive route to put finance back to public finance. So maybe there's a little bit role for international finance here too. Thank you.
Thank you for inviting me to this great conference. So my paper is not difficult to motivate to this audience, and after all the discussions that we had, it's a paper about the end game. So consider a country where the government debt dynamics are unsustainable, debt is increasing without bounds. What's the end game? So there could be a fiscal adjustment, that's the good outcome. There could be a default, or there could be a third alternative, and this is what I want to talk about, which is financial repression. But what do I mean by financial repression? So for the purpose of my paper, since I'm interested in this endgame, I'm going to call financial repression all the policies by which the government can use the banking sector to avoid a default, right? Because I'm looking at this alternative. Now, even if the definition of financial repression is restricted in this way, there are many different forms of financial repression one can think of. There are relatively mild forms of financial repression when the central bank or the banking sector as a whole purchases government debt on market conditions. Or there could be much more intrusive forms of financial repression, like what we saw in the US in the 1950s and many other countries, where the banking sector is forced to accept to receive a below-market interest rate on debt. So I'm going to present a model that captures these different forms of financial repression, and then I will show you a little bit about the data. Given the time constraint, I'm going to skip the discussion of the literature. So basically, the model is a model in which we have a government. The government debt dynamics initially are unsustainable. I talked about the possible outcomes. And I'm going to, in the model, characterize the optimal default-preventing financial repression policy as a Ramsey problem. So I'm going to treat financial repression as one would treat some kind of tax policy. And then I will show you in the data how the model fares when you compare it to broad features of the data, right? So I'm not really testing the model against alternative. I'm just looking at the data through the lens of the model. Okay, so the model, I don't have time to present the equations of the model, so I removed all the equations. I'm going to describe the model heuristically. So this picture shows you who is in this economy. So you have a government, you have banks. I'm putting the central bank in the banking sector. I could have consolidated with the government. That would have changed a little bit the story, but not the results. And then we have the non-bank private sector, so households. The government issues debt. Some of it is held by bank, that's the L. The rest is held by households, that B. Households hold some bank liabilities, deposits, M. And banks and households also hold some real assets that yield a return. So here, when banks buy more government debt, there are two margins of adjustment. They could reduce their lending to the real sector, and so there is going to be crowding out. Or they could increase the size of their balance sheet, right? So issue more liabilities, more M. The model is completely real, so it has nothing to do with the fiscal theory of the price level. And I did that on purpose because I wanted to show that it's not at all about debt inflation. Okay, so the model is welfare-based. We have risk-neutral households maximizing their utility. And I'm going to distinguish two types of financial repression. So first, there is what I'm calling balance sheet financial repression, which is getting the banking sector, including the central bank, to buy government debt. And the second kind of financial repression is what I call quasi-fiscal financial repression, and it's about extracting from the banking sector resources that can be used to repay the debt. So the second, and there are many ways of doing that, and I'm not going through all mechanisms, but you could say, okay, the central bank is going to buy a lot of debt, it's going to force the bank to hold reserves, and then it's not going to pay an interest rate on reserves, and the bank is going to make a big profit, and it's going to give it to the government. So that's one way you can extract those quasi-fiscal resources, but one could make a list of the different ways. Then there is default. So here the model is a standard model of default. There is opportunistic default. The government will default if this increases its objective function. And there is no commitment to repay. So the government wants to default because when debt is very high, you have to levy a lot of taxation on labor, and it's costly, it's distortive. So there is a point at which you prefer to default as opposed to repay. And if you default, you have an output cost. So these assumptions are standard. Now, I'm assuming that the government default on non-bank creditors, right? So the households. It does not default on banks. It's also a standard assumption. It's usually justified by saying if you default on banks, then you have a banking crisis on your hands. It's very costly, so you don't do it. Now, if you have a secondary market, it's difficult to default selectively. You have to segment this secondary market. And another way you can implement the allocation is by defaulting on everybody, but then compensating the banks with a bailout, right? And you would get exactly the same result. Now, it's an important assumption because it's implied that the non-bank sector has a limited absorption capacity. There is a point at which it doesn't want to buy more debt because it knows that it makes itself vulnerable to default by doing that, which means that at the margin, when you issue more debt, you have to place it in the banking sector. In some sense, borrowing from banks has a commitment value. It replaces, it's a substitute to the absence of commitment, right? You cannot commit to repay the non-bank creditors, but you can commit to repay the banks. So you can borrow more from the banks. Now, what's the cost of financial repression? First, balance sheet financial repression distorts the balance sheet of the banking sector. And here there are two costs. First, there is a cost of crowding out lending to the real sector. And here I assume that banks have a special advantage in managing some assets. So that's where the crowding out cost comes from. And then there is a cost of expanding the balance sheet of the banking sector excessively, excessive leverage. It could be a pure management cost. It could be also the cost of the risk of financial crisis and so on. Now, importantly, expanding the balance sheet of the banking sector is not necessarily inflationary because banks can issue deposits, but they can issue debt. Debt that has no utility, no transaction utility, right? So banks issuing debt is not more inflationary than the corporate sector issuing corporate debt. And so here I'm trying to disconnect financial repression for everything we hear about hyperinflation, monetization, and so on. Financial repression is not the same as monetization. So that's the cost of balance sheet financial repression. Now, the cost of quasi-fiscal financial repression is that it reduces the resources available to pay on deposits. So it makes deposit holding more costly. It's a standard cost. And I assume that this welfare cost is higher than the cost of increasing taxes, labor taxes. So it's more, financial repression could be viewed as a source of fiscal revenue, but it's more distortionary than regular taxation. Now, it's a realistic assumption. There is a whole literature about the welfare cost of inflation and the optimal rate of inflation when you can choose between an inflation tax and a labor tax. And the conclusion from this literature is that you don't want to do financial repression. Other taxes, even though they are distortive, tend to be less distortive. Okay, so why use financial repression? So this is where I introduce the fiscal deadlock. The first best would be to do a fiscal adjustment. But I assume that it's not possible immediately. There is a Poisson process that brings a possible fiscal adjustment. So there is a constant flow probability that a fiscal adjustment opportunity is going to arrive. By contrast, financial repression can be used at any time. So financial repression is nimble. Why? Well, because it has a very different governance, right? It's about banking policies. It's delegated in general to the central bank. And the central bank can do it very quickly, overnight, for the sake of financial stability. It can buy government debt, it can change banking regulation, and you do not need an agreement in Congress to do that. Okay, so this is the setup in which I'm trying to capture the essence of the situation. And then I solve for the optimal financial repression policy as a Ramsey problem. So there are three variables in the financial repression policy: how much government debt the central bank or the banking sector buys, how this debt is financed, is it by crowding out or is it by expanding the balance sheet, and how much quasi-fiscal taxation do you impose on the banking sector. So let me jump to the result. I find that, and this is intuitive, I think, that there are three stages in equilibrium. So so let's imagine you are in this state where first we start in an active fiscal policy a la Leaper, and debt is exploding, and then with some probability we could switch to a passive fiscal policy and stabilize debt. So debt, D, here on the x-axis is increasing over time. As long as it is lower than a certain threshold, you don't need to do financial repression. There is enough appetite in the non-banking sector to buy all the government debt. Now, under some conditions, the banking sector could also buy some debt because there is some indeterminacy. If the amount of assets for which banks have a special advantage is limited, banks could also hold some debt. But they are not, you don't force them to do that. And then at some point, you have exhausted the buying capacity of the banking sector, and so you have to start selling government debt to avoid a default. You sell it to the bank, to the central bank or to banks. So it is the balance sheet financial repression stage, the second stage. So L, the amount of government debt held by banks, start to increase. At the margin, you sell any dollar increment of debt to the banking sector. And you finance that both by crowding out and by expanding the balance sheet of the banking sector. Now, the problem is that the distortionary cost of expanding the balance sheet of the banking sector grows over time. You have this flow cost, right? And so at some point, it becomes large enough that you don't want to do that anymore, and you switch to quasi-fiscal financial repression, which is costly, but when you reach a certain size, it's less costly than continue to increase the size of the banking sector. So this gives you a kind of phase, a pecking order. You want to use the most intrusive form of financial repression, but only in last resort when you have first increased the balance sheet of the banking sector by a lot. Okay. So I'm just going to now look at the data through the lens of the model and see if things look like in the model at a very broad level. Here I'm just restating the implications of the model, but let me skip that and go to the charts directly. I'm going to show you essentially two charts, so it's going to be pretty short. So the first chart is looking at this prediction of the model that at the beginning, most of the debt is not in the banking sector for low enough government debt to GDP ratio, but then as you increase the government debt to GDP ratio, at the margin, you accumulate it in the banking sector. And it looks, and this is right, it's a many country, one story result. I'm showing you here only the G7. I could show you the same chart with all advanced economies, and you would see broadly the same thing. When government debt to GDP is below 100%, at the margin, when you increase the ratio, some of it accumulates in the banking sector, but to the tune of 1/4, 1/3 of it. But when you reach 100%, suddenly the slope increases, and it increases to 1, in fact. So this is driven in part by Japan, which you see here. It's the red line. But not only Japan, Italy contributes to that too. And if you look at the US, which is the blue line at the bottom, you see the US is very flat until close to 100%, and then the slope increases above the threshold. So you can do the econometrics of that. So you do a threshold regression. So I'm showing you the results here. It's estimating a debt threshold where the slope is going to change. Depending on whether you look at the full sample, 30+ countries, or only the G7, or G7 excluding Japan, you find very similar results. So what I showed you is not driven only by Japan. And what you find is that there is a threshold between 100% and 120% of GDP where the accumulation behavior of government debt, where the debt goes, changes. Below, about 1/4 of the debt accumulates in the banking sector. Above the threshold, it's 100%. So it's not a test of the model. One could think of other models, but I think it's pretty striking that this is very consistent across countries and over time. Then I want to look at another feature of the data, which is how do banking sectors finance these purchases of government debt? And is it mostly at the crowding out margin? So do they buy more government debt by lending less to the real sector, or is it more by expanding their balance sheets? So this is the next chart. So both are plots. On the horizontal axis, you have the 10-year change in the ratio of bank-held government debt to GDP. So each point is a country 10-year window pair. And on the y-axis, on the left-hand side chart, you have the change in currency in deposits, so a measure of the liabilities of the banking sector as a whole. On the right-hand side chart, you have the change in bank loans to GDP. So if the purchase of government debt was financed by crowding out, what we would see on the right-hand side chart is a negative slope, right? So the more banks buy government debt, the less they lend to the real sector. We don't see that, so there is no evidence of crowding out. What we see, and this is the left-hand side chart, is a very positive correlation between the purchase of government debt. So I forgot to say, I look only at the more than 100% of GDP debt, right? So the first stage financial repression regime. I look only at observations where government debt to GDP ratio is larger than 110%. Okay, the left-hand side is telling you how this is financed. It is financed by expanding the liabilities of banks. Next, okay, so here I would like to give you a kind of broad view that is given to us by the model and the data. So based on what I've showed you, I would say several advanced economies have entered the first stage of financial repression, the balance sheet stage of financial repression. So certainly Japan, Italy, but also maybe France and the US have crossed the threshold. Banks have financed their purchase of government debt mostly by expanding their deposits rather than by restricting their lending to the real sector. So again, here, I forgot to say there is a literature on crowding out, and it found that purchasing government debt crowds out bank lending, but at a relatively high frequency, quarterly frequency in Europe. Here I'm looking at much longer time periods, right? So what I'm telling you is at a very low frequency, there is no crowding out. There could be a little bit of crowding out at a higher frequency. Okay. There is little evidence that advanced economies have entered the final quasi-fiscal stage of financial repression. So if you look at Japan, it is still a very market-based financial sector. And so if I wanted to interpret this state of the world through the lens of the model, so assuming, and this is a heroic assumption, that what we are looking at is optimal financial repression policies, I would say it looks like a world where expanding the balance sheet of banking sectors is not very costly, at least relative to the cost of doing hard financial repression and trying to extract quasi-fiscal revenue from banking sectors. And so what governments have done is just that, have banking sectors buy government debt. With a caveat, which is that this conclusion is heavily influenced by the case of Japan. And Japan was in the liquidity trap, and it could be that when there is a liquidity trap, it's much easier to expand the balance sheet of the banking sector. So here there is a discussion about the R-star in the future to be had. That's my last slide, because I'm going to skip the conclusion. So here I'm trying to be a little bit provocative and defend financial repression. Now, obviously, throughout my analysis, it's not the first best. The first best is a fiscal adjustment. So let's be clear on that. But if a fiscal adjustment does not happen, the relevant comparison is between financial repression and default. And financial repression buys time. You had this metaphor yesterday about the bicycle going down the slope. And here in my model, buying time is a good thing, because you can repair the bicycle as you go down. So here I'm just showing you a little back of the envelope calculation. I'm just saying, well, let's assume government debt in the US continues to increase at the rate that we have seen. When does it reach Japanese levels? Okay, the answer is more than 35 years, 35 or 40 years. Let's assume that the probability of fiscal adjustment is such that it happens, it takes on average 20 years to have one, right? So it's not, it takes time, but you have 40 years. The analysis tells you it's very valuable to have this promise of financial repression, because it gives you time, and this time can be used to do fiscal adjustment, and then you are back to normal. If you promise not to do it, then the alternative would be a default, which would be very costly.
Hello, everyone. It's a pleasure to be here. Thank you for inviting me. It's a special pleasure to discuss a paper that has fiscal deadlock in the title when we have a government shutdown. So I think that I will move on to make a brief outline of my remarks. First, I am going to do just a couple of quick slides to motivate, as a preamble, Olivier's model, and more generally the issue of financial repression. Like Olivier, also I will talk a little bit about the definition of financial repression. I am going to talk about a couple of the assumptions in the model that merit some further discussion, and go on to discuss the evidence. So by way of motivation, let's start with what everybody knows in this room. If you take a long historic view of the advanced economy debt, it certainly, there is plenty of room to be considering what approach the government is going to take to reduce the said debt, or who is vulnerable to a credit event, a default, and how far in the future that is. So I think I don't need to belabor the point. And if I showed you this graph, unfortunately, over a shorter horizon, because I don't have the full data set, of debt relative to revenue, it would look worse. The second chart that I wanted to use to motivate the idea of sovereign fragility is that advanced economies are not quite the advanced economies that they used to be in terms of credit risk. And so what this chart highlights is the evolution. This is a numeric score, which is average for Fitch, Moody's, and Standard & Poor's. And I think it's fairly self-explanatory that certainly even before the global financial crisis, we had seen some weaknesses, but certainly after the GFC, that those weaknesses became more apparent. And look no further than the recent downgrades in the United States, in France. Let's move on to the definition. As Olivier pointed out, his definition is any policy through which the government uses the banking sector to avoid default. I would argue or admit, and I'm going to elaborate on this a little bit, that without any loss, you can have a broader motivation for the government to embrace financial repression, which I'm just calling FR for short. Historically, financial repression has been a policy that's been widely used in advanced and emerging markets to reduce the cost of borrowing for the government. And so it can be very tempting for politicians, even if they have no clue that they're about to default, even if assuming they're myopic, but that they have other things they want to spend us on rather than paying interest on the debt. So financial repression more broadly, and my work with Belén Sprancia, we rely very heavily on the McKinnon and Shaw definition, and I'd just like to highlight a couple of the pillars, because later on when we talk about the empirics, I am also going to go back and ask the question, well, where are we in the stages of financial repression? So that's the aim of why I'm spending a little time on this. So financial repression involves a large footprint of the official sector in financial markets. How about a very large central bank balance sheet? Okay, official sector. Or it could be a foreign central bank buying a lot of the debt. So it's an official player. Tighter regulation. What about macroprudential regulations, liquidity requirements that require financial institutions to hold government debt? That creates a captive audience. Sustained low or negative ex-post real interest rates have been the hallmark and the aim of financial repression. It's an opaque tax paid by the creditors. It's an opaque tax on the bondholder, and like Olivier has highlighted, it can be implemented quickly, and nobody needs to vote on it. In the past also, we've seen, variations that have been involved implicit caps on interest rates, and all kinds of restrictions on what households or institutions can or cannot buy. So, for example, the prohibition to buy gold in the U.S., which in your model would drive you to hold more deposits than you otherwise would have because they're limiting your alternatives. Anyway, one last, before I talk about the model, one last point. I mentioned that financial repression has historically been associated with sustained, emphasis on sustained negative ex post real interest rates. This is not the most appropriate interest rate to use. This is a short rate, this is a policy rate. But I would argue that the shaded areas where we have seen sustained negative real interest rates historically have been associated with an elevated level of financial repression. This, surprise, surprise, involved the 2 world wars and the inflationary 1970s. The post-GFC era was the longest of these periods, and the only one that didn't involve higher inflation rates until the very end. Okay, if you didn't like my former definitions of financial repression, you didn't like Olivier's, you didn't like mine, maybe I think this quote makes it very plain. Cheap finance, it's about cheap finance. So, I'm going to just mention 3 assumptions that, the first one is Olivier aggregates the central bank with the commercial banks, with the private banks. In my discussion on empirics, I will separate these, so just note that that's coming. The second is the model assumes that over and beyond distorting the balance sheet of the banks, financial repression is more distortionary than other taxes. Well, I would argue that that depends what those other taxes are. A lot of the tariffs, highly differentiated, very subject to rent seeking and so on, very big differentiation across industries, across commodities, can produce a very distortionary level of taxation. So, I take that with a grain of salt, but I'm not going to dispute that. I'm not. Then the last point, and I think Olivier handled it beautifully in the discussion. He convinced me because when I read in the paper, the way he described it was much more compelling. When I read in the paper that, well, the government can default on non-banks, but not on banks. And I said, whoa, you have a securities market. They're holding, the same 10-year bond is being held by different agents. How can you segment? And I think the way I would characterize it is everybody is defaulted on, but the banks get a smaller haircut, i.e. The bailout that he mentioned. Second point on the, and I'll move quickly, on the model, he sets up the stages of progression. In the green, we have no financial repression, so there are no distortions. In stage 2, the crowding out is already emerging, so the amount of government debt held by the banks is already larger than what they would like. And you could rationalize that easier through the macroprudential regulation that I alluded to, right? You need to be liquid, you need, but in the red is when the actual transfers to the government take place. Stage 3, and I left one eye, so the red is stage 3. I would argue that if you separate out the central bank from the commercial banks, in reality, the central banks have been making transfers to the government because they transfer profits, and as the balance sheets got bigger and bigger, the transfer also became bigger and bigger. So that I will, highlight that maybe we're further along than Olivier concludes. Central bank balance sheets, this I'm going to go through quickly because it pairs very nicely with what Olivier's already shown. You know, the bottom line is as debt levels escalated in advanced economies, so has the holdings of central bank balance sheet. I think this graph shows for the last few decades the scale of the expansion in central banks' holdings, and this classifies importantly as a large official footprint. And again, you know, the transfers from the central bank are connected to the size of its balance sheet. I would also argue that while the previous graph was from 1989, if you take a long view, it really shows how extraordinarily high the growth in the central bank balance sheet has been. You know, it is unprecedented, and unprecedented meaning really unprecedented. It has surpassed the level of the World War I and World War II. So this is a variation of what Olivier showed. This is just, however, for the central banks. And again, it's, you know, very suggestive, but it's the correlation between the level of government debt and the holdings of the central bank. Why am I so insistent on separating and singling out the central bank? Well, in the model, it's a real model, so inflation is not a concern, but in real life, you know, the implications for potential inflation from a growing balance sheet is something that we need to address. And finally, in my chart here, what I'd like to talk about is really more food for thought for the existing model. The model, Olivier's model, assumes a constant real interest rate. I would argue that the variations of financial repression, you know, that you get the central bank holding more debt, the banks, because of macroprudential, are holding more debt. Perhaps, as I will highlight, the other non-banks are also holding more debt, that collective expansion in official holdings actually reduces the cost of borrowing for the government. So endogenizing, perhaps it's something for the future, but endogenizing the interest rate would be, I think, a very worthwhile discussion. I focused so far on the central bank, but let me highlight that what Olivier said is very much the case. In 20 out of the 23 advanced economies, bank holdings of government debt have also expanded significantly. This just highlights that. Of course, I'm going to leave that discussion aside because I have no time, but it's also worth mentioning that while the idea of a doom loop is not considered in the model because we've ruled out, you know, the banking crisis, but the doom loop is a source of concern when you take a look at this chart. Last point, I promised you. Non-banks, they were also hit. So this is, you know, goes to the broader definition of financial repression. Regulatory changes that got institutions to hold more debt government debt, were not limited to banks. And let me just conclude how much I like this paper. I think it helps us think about how it progresses. You know, of course, you might have gathered with my remarks that I have a darker view as to where we are in the financial repression process. I think we're further along, although that doesn't say that I think default is around the corner. It's a more, and I will conclude with the suggestions that I would love to see extensions that involve foreign holdings, because that has played a big role over time, and endogenize the real interest rate, but I enjoyed it very much.
Thank you very much. I'm sorry for not giving all of you not enough time. Actually, we are a little bit behind of our time. I have two quick questions, one each to each paper. The first one to JR. Would Japan have sustained such a high debt level if global market rates had been much higher than the domestic rates in Japan? For example, Japan 0%, US 0% is quite different environment from Japan 0% and US 5%. Do you think fiscal debt capacity depends on global versus domestic interest rates environment? The other question to Olivier is about stable coins. The widespread use of stable coins may raise the debt absorption capacity of non-bank investors, especially for short-term treasury bills. But it also makes it harder for banks to expand deposits at low cost. What implications might this have for the overall fiscal capacity and the potential onset of financial repression? Would you mind answering?
Yeah, I'll be brief. So first, I want to really thank Zhengyang for his discussion. It's a rare privilege to give a presentation with some author's name on the presentation and actually have the same person discuss your paper immediately thereafter. And I will say one thing about the Zhengyang's point about the exchange rate as another form of adjustment consistent with his job market paper. First, we're planning on doing that to test it out. Hopefully we get results consistent with your job market paper. Second, we actually have this in the paper. We're building an open economy, new Keynesian model that has exchange rate adjustment with all the bells and whistles to try to explain this. Here, we just focus exclusively on the price level, but that's the obvious next step. In terms of the Japan question, I'm really going to cheat off of Zhengyang. He already gave the answer, which is, yeah, basically the reason why that market value of the debt to GDP ratio for Japan was so much higher than the present discounted value of surpluses is because there's been a large amount of financial repression in Japan. The question was, all right, so if other countries engage in financial repression and drive their interest rates to zero, is that really sustainable? I think Hano, your co-author, has actually a great paper on this recently where in the case of Japan, it was a combination of financial repression keeping domestic interest rates so low, and also the fact that through a form of the carry trade, international foreign interest rates were a lot higher. So Japan was effectively engaging in this carry trade. It's assets of the consolidated balance sheet have a much larger or longer duration than its liabilities, so there's a risk there, which is, okay, if we assume that the carry trade isn't going to hold, we saw this last year, the Japanese yen actually appreciated quite a bit. There were some scares in financial markets. This is like my first week on the job at PIMCO. What was the implication of that for fiscal sustainability? Probably not good for Japan. And that's pretty much all I'm going to say on that.
How much time do I have? 2 minutes? Or?
2 minutes.
Okay. So thank you for your comments. I think, so you said you disagreed on some points. I think to a large extent these are semantic disagreements. So you mentioned in particular quantitative easing and the impact of quantitative easing on long-term interest rates. So you are saying, well, this should belong to the last stage, quasi-fiscal stage. I mean, it's analogous to quasi-fiscal financial repression. I mean, the reason I'm not including it, what I put in the last stage is really interventions that distort interest rates. And then there is a semantic question of what distorting interest rates mean. So it's true that quantitative easing reduces long-term interest rates, but it's still a market interest rate. So the government is borrowing at a market interest rate, not at a below market interest rate. Is it distorted? Well, it's largely a question about the intentions of the central bank. So if the central bank is doing it to achieve the objectives of monetary policy, it's just monetary policy. It's not more distorted than open market operations with short-term bills. If the central bank does it to make it easier for the government to borrow, yes, it's distorted. So I think in the quote of Trump that you showed in your slides, there clearly the notion is that monetary policy has to deviate from its objectives to help the government to borrow. So this would be, and he's calling for a distorted short-term interest rate. Now, whether quantitative easing was really about helping the government to borrow by lowering the interest rate, I'm not completely convinced by that. It seems to me that it was helping the government because maybe it would have been difficult to sell all this debt in the non-bank sector. But whether this was done really to reduce, the long-term interest rate by a fraction of a percentage point, it's possible, but I'm not entirely convinced. I mean, I don't have the evidence on that. And quantitatively, I mean, if you look at the literature and the impact of quantitative easing on long-term interest rates, it's typically a fraction of a percentage point. So it's not a game changer for the dynamics of government debt. But having said that, I completely agree with you that there should be an extension of the model in which the impact of quantitative easing is captured. And I think in this extension, there would be a trade-off between expanding the balance sheet of the banking sector, which is costly, and reducing the interest rate, which is a benefit for the government. So there would be a new and interesting margin to the analysis. Coming to Sunghwan's question on stable coins, yes, I think it's a very interesting aspect of the problem. To the extent that stable coins have to buy government debt, it's going to increase the demand for government debt, although we have to think about the impact of stable coins on banks and the impact it's going to have on the demand, on banks' demand for government debt, so it's complicated. I think when it comes to financial repression, I don't see why stable coins would be beyond the reach of financial repression. So if the US government really wants to do financial repression, well, then it would have, and stable coins, there is a big development in stable coins, then it would have to include stable coins in the regulated financial repressed sector.
No, just one thing on the stable coins. No. Just one thing on the stable coins is it's a vehicle for capital flight. It's in parallels to the market, so it's a vehicle for capital flight. So can it
Yes, but as we can see with financial sanctions, I mean, as long as you have to be linked to the US dollar system, you are not, beyond the reach of the Treasury's arm. So,
Great, thank you very much. Do I have time for one or two questions, or should we finish here?
Well, what we're going to do is we're going to get lunch, settle down, and start the conference questions. So maybe take, no more than 3 more minutes. So take one question.
So I'll take just one question.
Sorry.
Yeah. Anyone? anyone who has to ask questions.
Questions bilaterally afterwards, so let's
Okay, yeah, thank you very much.